Hey, welcome to the What the Wealthy Do podcast, the podcast where we pull back the curtain on all the strategies that the wealthy use to build their wealth and show you how you can apply those same strategies to your daily life while you're on your wealth building journey. I am your host, Stephanie Dorsey. I'm the CEO and co-founder of Margins Capital. Margins Capital is an investment firm that provides women and people of color access to an institutional quality portfolio of alternative investments. All right, so we've talked about how to evaluate stocks, how to assess private equity and venture capital deals, but today we're going a level deeper. We're talking about how to vet the people who manage your money. Yes, we're talking about the fund managers, the wealth advisors, the investment firms. Me. We're talking about even me as a fund manager for Margins Capital. We're talking about the investment firms that are asking you to trust them with your hard-earned capital. Because here is the thing. When you invest in a fund, you're not just betting on a strategy or a portfolio of companies. You're betting on people. The people you are trusting that they have the skill, the integrity, and the discipline to grow your wealth. And let me tell you, there are a lot of people out here with fancy websites, impressive titles, and slick pitch decks who have no business managing anybody's money. Oh my God, the snake oil salesmen are out here. They are copying my TikTok pages. It is crazy. And I just want to make sure that you are being absolutely safe. And so the wealthy, at least the smart ones, we're not talking about, because all wealthy people are not smart. I ain't gonna even hold you. Right? Today, we're talking about the Warren Buffetts of the world. We're talking about the really, really savvy investors. These people are not just going to hand over millions of dollars to anyone with a tie and a pitch. They conduct ruthless due diligence on fund managers before they invest a single dollar. Today, I'm walking you through the exact process that these wealthy, sophisticated investors use to vet fund managers and the red flags that should make you run for the hills. And yes, I know that some of you all are listening to this and you are going to redirect all of these very hard-hitting questions towards me, and I applaud it and I love it, and that's what I want. And anybody who get an attitude when you ask them questions about who they are and what they can do for you, again, red flag, like, you know what? All right, be good. You don't need my money then, because, apparently I'm getting on your nerves. That's the attitude I want you to have for them. So this is critical information, whether you're investing in a hedge fund, a private equity fund, a multi-strategy fund like mine, or just choosing a financial advisor. It is what it is. Like, they need to keep it a buck with you, and you need to be able to ask these questions. But before we get into it, you know the drill. This is financial education, not financial advice. Okay, let's go. So first of all, before we start, I just want you to know, the reason why due diligence matters for fund managers is, let me paint the picture for you. Okay, you have the best investment strategy in the world, the perfect mix of assets, the right sectors, the ideal timing. But if the person executing that strategy is incompetent, unethical, or just plain unlucky, you're going to lose money. And here's the brutal truth. The fund manager matters more than the fund. That's crazy, but it's true. It's so true. A great manager can turn a mediocre strategy into outsized returns. A bad manager can destroy even the best strategy. So think about it like this. You wouldn't hire a surgeon to operate on you without checking their credentials, their success rate, and their malpractice history, right? The same logic applies to fund managers. But here's the problem. Most people don't do this level of diligence. They see good past performance, a fancy office, and some glowing testimonials, and they write a check. Even some rich people, legit. But as a wealthy investor, because that's what you are, and I'm claiming it over your life, I want you to dig deeper. I want you to ask the uncomfortable questions, verify everything, and walk away from most opportunities because they don't pass the test. That's the mindset we're adopting today. There are 4 pillars of fund manager due diligence. At Margins Capital, when we're evaluating a fund manager, whether we're considering investing our own capital or bringing them into our network, we assess 4 key areas. 1, we look at their track record and performance. 2, we look at their investment process and philosophy. 3, we look at the team and organizational structure. And 4, we look at integrity and alignment of interests. If a fund manager doesn't pass all 4, we don't invest, period. Period, we don't. So let's break down each one. Number 1, track record and performance. The first question is, can this person actually deliver returns? And here's what you need to look at. You need to look at historical performance, but don't stop there, because obviously you want to see a track record of strong returns, but past performance alone doesn't tell the entire story. You want to know how long they've been managing money. Like, you want at least 5 to 10 years. One good year doesn't prove anything. You want to know how they outperform benchmarks consistently. A benchmark is just another way for their competition. Anyone can get lucky once. You want to see consistent outperformances across multiple market cycles. If they had a down year, you want to know why. And they should be able to articulate what happened, because it's not always going to go up and to the right. Even the stock market has dips, right? And that's okay. But you want someone who is steady at the helm of your money. And when I think about the fund manager that we invested in, Taurus, his investment strategy, he's looking at companies that are in the utility space, but as well as companies that are in the government contracting space. Now we're in this very, very uncertain realm with like this current administration. And so it's currently impacted one of our portfolio companies that's in the government contract space. And so he has slowed down the allocation of money in light of what's happening in this uncertain environment. And I love that. I love that. Don't just make it rain and hope for the best. No, he is being thoughtful and slowing down the deployment of capital. And that's the kind of steady leadership you want at the helm. The key metrics to ask for is internal rate of return, IRR. For PE and VC, you want to see 15 to 25%. You want to ask for MOIC, or multiple on invested capital. If you invest $1, you want to know how much you're going to get back. So like, you want 2 to 3x for PE. It'll be much higher for VC. You want distributions to paid in capital. DPI, this is critical. You want to know, have they actually returned cash to investors, or are all of their performance just on paper, like unrealized gains? Quartile ranking. How do they rank against other funds in their category? Top quartile is where you want to be, clearly. Fee structure, 2 and 20%, 2% management fee and 20% carry. That is basically a performance fee. So if your fund performs and they make you money, they start to share in the returns of that money. So they'll keep 20% and then they'll give you 80%. And what you want to know, though, is that's the market rate, 2 and 20%. If it's above that without any explanation, you're like, why? Right? That's something that you deserve an explanation on. Also, you want to know a little bit about fund size. Like, if it's too small, there probably won't be enough diversification. If it's too big, it'll be hard to deploy efficiently. So they should be able to explain that to you. A red flag is if they only share their best performing funds and won't share you the others. That's a problem. Transparency is non-negotiable. Non-negotiable. So you want to also get an understanding of how much of their performance can be attributed to skill versus luck, right? So just because a fund has some good returns, it doesn't mean the manager is skilled. Maybe they got lucky. Maybe they took crazy risks that happened to pay off. So you want to ask them, what drove their returns? Was it 1 or 2 massive wins, or a consistent performance across the portfolio? Is the strategy repeatable? If they made all their money on one lucky Bitcoin bet in 2017, that's not a repeatable strategy. How much risk did they take on to achieve those returns? A fund returned 25%, but it took 50% more risk than the benchmark. Isn't impressive, it's reckless. And also, you don't want a manager who has 1 amazing year and 4 terrible ones. You want steady, consistent performance. Okay, so they have a good track record, but now you need to understand how they generate their returns. You want to understand, what is their investment philosophy? Like, every great fund manager has a clear, articulatable philosophy that guides their decisions. For example, Warren Buffett, he believes in value investing, buying great companies at fair prices and holding them forever. Ray Dalio is the founder of Bridgewater Hedge Fund. He's an all-weather strategy. He diversifies across asset classes to perform in any environment. And so you want to ask the fund manager, What's your investment philosophy? Like, so margins, if you ask me that, I would say we invest in a diversified portfolio of alts to mitigate risks and maximize returns. And then you want to ask them, like, why do they believe that this approach works? And I would say, if you ask me, we believe this works because it allows us to stay nimble and opportunistic across 4 different asset classes. And then how long have you followed this philosophy? We're going to say we've been following this strategy for 5 years. And a red flag, if they can't articulate a clear philosophy, or if their philosophy changes every few years, they're just chasing trends, and they don't have to do that with your money. So the philosophy is the why, the process is the how. And so you need to understand their decision-making framework. How do they source deals? Do they have proprietary deal flow? Or are they just picking from the same opportunities that everyone else is? How do they evaluate investments? What's their due diligence process? Hint, if it's not rigorous, walk away. How do they make decisions? Is it one person's gut call, or do they have an investment committee? How do they manage risk? Do they use stop losses? Do they hedge? Do they size positions based on conviction? How do they decide when to exit? Do they have clear criteria, or do they just play it by ear? A repeatable, disciplined process is what separates professionals from gamblers. You earn good money, real good money, and yet you're still not entirely sure how to manage it and invest it. You've listened to the podcast, you've attended the webinars, and you've already started investing. And somehow with all of that, you're still second guessing and afraid that you won't be able to create that 7 or 8 figure wealthy life of your dreams. The Sovereign Collective was built just for you. A judgment-free and safe space specifically for high-earning Black women who are ready to stop pretending that they have it all together and actually start building generational wealth. Just 20 seats, 20. Learn more at joinsovereign.co. And remember, you are always wealthy. Then you want to know, how do they add value? For PE and VC funds, this is critical. It's not enough that you just pick good companies. The manager needs to actively help those companies grow. So you want to ask them, what operational expertise do you bring? Can they help with hiring, sales strategy, operational efficiency? And you ask, what's your network? Can they open doors to customers, partners, or investors? How hands-on are they? Do they take board seats? Do they have weekly check-ins with portfolio companies? The best fund managers are partners and not just capital providers. The third pillar, we look at team and organizational structure. Even the best fund manager can't do it alone. You need to evaluate the entire team. 1, who else is on the team? Who's making the actual investment decisions? What's the track record? The operations team, who's handling compliance, legal, reporting? Are they experienced? The portfolio management team. For PEVC, who's working directly with the companies? Red flag. If the fund is basically one person with a few junior analysts, that's risky. What happens if that person leaves or gets sick? So you also want to look at how stable is the team. If there's high turnover, that's a potential red flag. You want to ask, how long has the core team been together? Has anyone left in the past few years? Why? If people are leaving, that's a sign of internal problems, bad culture, disagreements over strategy, or unethical behavior. And this is the last and most important pillar, in my opinion, is integrity and alignment of interests. I don't care how good someone's track record is. If they lack integrity or their interests aren't aligned with yours, don't invest, for real. A couple of ways to test this is the manager investing their own money. This is non-negotiable. If a fund manager isn't investing their own capital alongside yours, they don't have skin in the game. So you want to ask how much of their personal wealth is invested in the fund, and do all the partners invest their own money. You only want to invest in fund managers that eat their own cooking. Like, if they don't invest, like, run. That's crazy. You also want to understand what their fee structure is. The market rate is 2% management fee, 20% carry or performance fee on profits above a certain threshold. So you want to ask them what their fees are, and you want to know if there's a hurdle rate. And this means the fund has to achieve a minimum before they start to take their 20% cut. And you also just want to understand if there's some additional fees, like legal fees or consulting fees or things of that. If you want to be wary of managers who charge consulting fees to their own portfolio companies on top of the management fee, I mean, that's clearly a conflict of interest. And then you need to make sure there's haven't been any fraud or any type of impropriety, right? So you definitely want to do a background check. You want to Google them. You want to look for SEC filings and enforcement actions, lawsuits from investors, articles about misconduct or unethical behavior. You can check FINRA, FINRA, broker check for registered advisors. You can also check SEC's investment advisor public disclosure for fund managers. If they have a history of regulatory violations, lawsuits, and or shady behavior, it's a wrap, dog. So here are some red flags that you should absolutely walk away. Lack of transparency. If they won't share performance data, fee structures, portfolio details, or even other LPs, just don't invest. They should be absolutely transparent with you. If they try to pressure you to invest quickly, this opportunity closes Friday. It's a sales tactic, not a sign of a good investment. Good funds don't need to rush you. If they over promise, if someone guarantees returns, promises like you'll make 10x your money with no risk, oh my God, they're absolutely lying. All investments have risk, all of them. Like in the stock market, in the public markets, as well as in private markets. If they have complicated or unclear strategies that you can't understand what they're doing after they explain it, walk away. Complexity can hide fraud. Remember Bernie Madoff. Any personal red flags, like if your gut tells you something is off, if they're evasive, arrogant, dismissive of your questions, trust your instincts. Like if you're investing with the fund manager in private equity or venture capital, like you're going to be in a relationship with them for 5 to 10 years. So your intuition, it's really golden. You should feel good. You should feel convicted about investing with them. So again, you should trust but verify. So do a reference check. You can ask them for current or former investors so you can understand what their experience has been like. You can understand if they've received distributions. You can ask them if they would invest again. If they invest directly in portfolio companies, we do, but we don't. We invest with other syndications, so they won't be able to say yeah, margins has helped us with blah, blah, blah. Not yet. But if the fund that you're looking at does, ask to CEOs or executive team of the portfolio companies where they invest. And then perhaps you could look at if there are other fund managers who might have co-invested with this particular person. You can talk to them to get feedback on the person. Also, you can look at SEC filings. You could look at news searches to see, put the fund manager's name plus lawsuit plus fraud plus SEC or investigation. You should have your attorney review the LPA, the limited partner agreement, and or the subscription docs. But if you don't want to do that, because right now, really, you can use AI and you can upload the subscription agreement or the limited partnership agreement in the AI tool and ask them what is abnormal about this, or what should I be nervous about, or break down what's the most important thing that is shared in this document. I'm a lawyer and I'm gonna go ahead and tell you to go on and use that AI. I ain't gonna hold you. I wouldn't pay a lawyer to review a subscription doc. Not today. But anyway, I do want to put a little bit of a caveat. So I'm an emerging manager. Emerging manager just means this is a manager that is new, or a manager that is from a marginalized population. They're a woman, they're a Black person, or whatever. And just so you know, when you're dealing with a newer manager, they should have 90% of the things that you're asking for. But the track record, I don't have any realized gains yet, right? All of the gains that I have for my funds are unrealized. And so some of this information may or may not exist, but that doesn't stop you from asking these questions, and it doesn't stop you from being able to run a check on them. The beauty about this space is it's small and people should know you or the fund manager that you're evaluating. So as an emerging manager, and you're going to be looking at track record and whatnot, there is data that shows that emerging managers actually outperform non-emerging or majority managers. So look at that data and use that as one data point if you're evaluating an emerging manager. Also, as an emerging manager who runs a smaller fund, and the fund is smaller because I want my LPs to be able to get access, and to get access that is like not charging them $200,000 investment minimums. So a lot of our investments, we have to invest in syndications. We're not always directly investing and being directly on a cap table because we're writing $25,000 and $50,000 checks. And so that's the price of admission as we grow. And so when you're evaluating some funds, mine or others, you want to take that into account, especially if you're writing a smaller check. Obviously, what you can demand is going to look a lot different than if you were writing $1 million check. And I'm going to just say it like that. That doesn't mean you can't demand anything, but you just need to keep all of that goes into play when you're evaluating whether or not to invest or evaluating how a scrappy emerging managing fund is getting things done. Okay. I do not have a big team. But with that being said, just know that your money is your responsibility. You cannot outsource the management of your money. Not many people. Now, I'm a care. I'm going to care. I care about your money. Good God. Because frankly, my money is tied up. We invest 20%. 20% of the fund one was our own money. So I care about how well your money performs. But you need to do this level of due diligence because you need to exhibit that you care about your money, right? And you need to find people that's going to care as much as you do, even though that's going to be really difficult to do. One way is to make sure they have skin in the game. And that's one way for you to validate that they're going to care about your money as much as you do. But regardless, it is your responsibility. You know, you can't completely outsource the caring and the management of your money, especially if we're talking about financial advisors. So just remember, track record matters, but process matters more. Past performance does not guarantee future results, and alignment of interests is everything. Trust your gut. If something feels off, walk and you will sleep better at night. And don't let anybody rush you, and don't be afraid to ask uncomfortable questions. And never, ever, 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 ever invest in something you don't fully understand. So yeah, I think that's it. So if you found this episode was helpful, please share it with a friend. Don't forget to like and subscribe and leave us a 5-star review wherever you get your podcast, be it on Apple, Spotify, or YouTube. This was the last episode in our due diligence series, and we will see you next week. Bye.